focusing on the thesis and on gold and silver prices going higher. So now the thesis: why do you own gold? Why do you want to speculate on mining stocks? I think people are starting to catch up to me because I've basically expected kind of what's happening today, where you have $2 trillion deficits. Washington has printing out of control, and the Fed only has two choices. So if you go back to 2008, the Fed could do whatever it wanted to do. It didn't have a significant debt problem where they could expand debt. They didn't have an inflation problem. And the U.S. government was still the global hegemon. We didn't have this global south. We didn't have this bifurcation. We didn't have this multipolarity world, right? It was basically the U.S. dominating, China trying to catch up. And the Fed could do whatever it wanted to do. Take rates to 0, take rates to 1%, print as much money as they wanted to. And they did. But today's a whole different, and we've been doing it ever since. Now we're up to 40 trillion. Our interest payments are $1 trillion a year, and people are starting to catch on. People are starting to recognize this is out of control kind of attitude. I always knew it was going to happen because this is how it has always worked historically. Historically, governments have always pushed it as far as they could and then defaulted. That's what countries have done over and over again. They don't tighten the belt. When they get into a debt problem, they don't tighten their belt. And so what we just saw with the Fed yesterday, where they held and everybody thought they were going to raise rates. And I thought there's no way that they're going to raise rates because they've gotten into this situation now where you're over $1 trillion in interest payments. If they raise the rates, that's just going to go up. The average, I think, interest payment right now is around 3.5 on our national debt, 3.5, 3.75, and we have about a 4% 2-year. So they're getting so all the borrowing. I'm not sure what it is at 3 months, 6 months, 1 year, but all the borrowing is interest payments are going higher. So how can they raise rates? They're basically, the one thing about the Fed is, what people don't realize is the Fed has changed its mandate, but they haven't said so publicly. And as a matter of fact, Greenspan changed it, but nobody's really said it out loud. And everybody just keeps repeating over and over again that the Fed's mandate is basically containing inflation and full employment. And that's not it anymore. It really changed in '87 when Greenspan basically made a statement and said, when the stock market went down, I forget, it went down around 25% in one day. When Greenspan made the statement and he said, no, there's nothing to worry about here. We will do whatever it takes to make sure that basically the stock market doesn't go down, the stock market goes up. And they call it the Greenspan put. Well, when he did that, he changed the whole dynamic of the Fed, because at that point, the Fed really didn't care about full employment or low inflation. At that point, what they cared about was economic growth. So even if you have unemployment at 5-6%, that's fine with them. It's supposed to be down at 3 at full employment, right? They don't care about full employment. What they care about is economic growth. This is so important. So right now, Warsh, his number one priority it's like 80-20, is maintaining economic growth, where inflation is like 20%. Okay, we'll keep our eye on inflation. We'll keep our eye on it. We don't want it to get out of control, because ultimately that inflation could derail economic growth. So we don't want inflation to get out of hand, but the priority is economic growth. But they won't say that publicly. And again, they don't care about full employment. They just want economic growth. If you get a recession, right now we have an everything bubble. So if you get a recession in an everything bubble, we've never had this kind of situation before. We have basically a bubble in the stock market, bubble in housing, and a bubble in national debt. So all this is happening all at the same time. Back in 2008, the only bubble we had was housing, but now we have this multi-pronged thing. So if you get into a recession, basically it's going to get really, really messy and really quickly. And they don't want that. They don't do anything that they can prevent it.
While Washington wrestles with a set of tough trade-offs, the world's central banks have been making a different bet entirely. According to Bloomberg and World Gold Council data, China's central bank has now extended its gold buying streak to roughly 19 straight months, its longest run since at least 2015, even as prices pulled back sharply from record highs near $5,600 an ounce in January 2026. In June 2026 alone, the PBOC added about 15 tons, its biggest monthly purchase of the year, pushing official holdings above 2,300 tons. Central banks worldwide remain on pace to buy over 1,000 tons in 2026, treating gold less like a trade and more like insurance against currency debasement.
It got to the point where Janet Yellen said, "Don't worry, we won't have another economic crisis in my lifetime." And what she's saying was that the Fed has pivoted away from full employment towards, we'll do anything we have to do to make sure we have economic growth. So now the economic growth doesn't have to be very high. It can be 1%. As long as we have some. We got to have some. We can't go to zero. So Warsh's job is making sure we don't go to zero growth. That's his job. So I think that gold, going back to my thesis, the Fed really has got, by what they've done here, by allowing debt to get to this level, to allowing the interest rates to get to this level, is they've gotten themselves basically trapped. Now they only have two choices. Forget about the dual mandate. Now they really only have two choices. Number one is fight inflation, and number two is stimulate the economy. And again, it's not about full employment. That's just a moniker. We have 1% growth. We're happy. Okay, we'll check the employment rate. That's just noise, if you will. What's the growth rate? So their true mandate is, okay, we want to somewhat control prices, but we want to make sure we have economic growth. Okay, 1% or better. Let's call it that. So now they only have two choices. Right? Number one, fight inflation. Number two, make sure the economy grows. Now, whichever choice they make creates a crisis on the other side. So if they focus on economic growth, they're going to print money and create stagflation, create more inflation, right? Create a crisis there. That recession that they don't want. The other thing, if they fight inflation, then the economy is going to hurt and the economy is going to go into recession. So it doesn't matter what they do now, they're doomed. This is the reason why central banks are buying gold. Because the central banks know, they go, holy crap, America's screwed. There's nothing they can do now. So they're like, we got to get out of these dollars. We got to get out of these bonds. Let's buy gold. We got to start playing defense, or proactively offense, towards gold and away from bonds and stocks and bonds. Now this trend, it's not stopping. It's not stopping until the whole thing blows up. So in other words, this gold accumulation. Now the interesting thing is that the central banks are accumulating gold. The East is accumulating gold. Just last month, China bought in June 173 tons. So if you multiply that by 10, it's almost 1,100. So it's like 1,400 tons in annualized. Well, there's only 3,700 tons mined yearly. And India imports probably just as much gold as China does. So that's like more than 2/3 of all the gold. And that's just China and India. Then you have to throw the central banks on top of that. So those three are basically soaking up all the gold, right? And they keep accumulating. Guess who's not accumulating? The West, Europe and the United States. Well, eventually they're going to want some gold. I always say the people who are going to buy gold and silver are the people that don't have any. Like right now, they did a survey of 300 family offices. So these are basically affluent families, that basically local people who are managing their money. And 30%, 70% had zero gold exposure, zero. And they're like, why? Why would I want gold exposure? It doesn't, paper gold. No, give me that 20% annual return in the stock market. So 70% zero, and the other 30%, they only had an average of 1%, one. So nobody owns any gold. But when this thing does begin to turn, I call it the fear trade. So the reason why the thesis holds water, if you will, is the trends. The US government, the interest rates are going higher, the debt's going higher, the annual interest bill's going higher, and the debt bubbles are getting worse. Like the housing right now, housing unaffordability has never been at these levels. We're starting to see more bankruptcies in both businesses and households. There's no real green shoots out there other than AI. So the thesis for gold is just getting better and better and better.
Despite all that accumulation, most Western institutions remain almost entirely on the sidelines of the gold trade. Surveys of family offices, firms managing money for wealthy households, have found the majority hold zero gold exposure, and those that do typically allocate only around 1% of their portfolios to it. That imbalance feeds a theory longtime gold bulls call the coming fear trade, the idea that underexposed Western investors will eventually scramble into gold once economic strain becomes impossible to ignore. With housing affordability near historic lows and bankruptcies climbing across both households and businesses, proponents argue the groundwork for that shift is already being laid.
I'm a speculator, whereas speculator is only about 1% of all, pure speculators like me, only about 1% of all investors. Now, some people do about 5% do a little bit of speculation on the side. And so those are the people that, they have their standard investments and they're like, oh, that gold's got a good chance. And so I'll go ahead and throw some money in that and speculate on that. And so I think the majority of people that are coming into the gold and silver are kind of, they're not like me. They're not full bore, if you will. Most of the people that are coming in, they're just dabbling. They're like, okay, I want a little bit of exposure to gold. Give me some of these stocks that have this big alpha. It's like, I'm going to gamble a little portion of my overall portfolio. All right. And they're like, those are the ones that they don't really buy the thesis 100%. If they bought it like me 100%, they'd be all in like I am. So those people are like, okay, maybe Don's right, maybe he's wrong. In other words, they don't really believe it. And then your belief level is kind of on a continuum. You kind of like 25% Don's right, 90% Don's right? So this is basically predicting the future, literally. So I use $7,000 gold right now, today, to analyze gold stocks, and I use $200 silver. And I look out, 2 to 5 years out, and 2 to 3 years is kind of my sweet spot. I don't care about the next 24 months, really. I want to go, I'm looking at least 24 months out further. So my thesis is not in the near term, right? In the near term, all I'm looking for is deterioration, which I'm seeing. Now, the one thing that I do is I want to accumulate as many stocks and as many shares as I can before this thing burns to the ground. And I think we're running out of time here. There will come a time when I stop buying. And I've been accumulating for 20 years, these mining stocks. I have like 168 positions. And I found another one last night that was really juicy, making 169. And so all I'm trying to do is accumulate as much as I can. And so you want to buy smart, sell smart. So buying smart is buying, you want to buy dips. You don't want to chase these things. So when gold gets to, I don't know, somewhere around 5,500, somewhere in that, the next high, I will stop buying. I'm done. I'm not going to chase these things. And then once it gets to 5,000, I'll be very selective. The ones that are the laggards, the ones that people are ignoring. But I won't be buying very much. And so my buying is coming to an end. And because I'm really trying to buy low and sell high, whereas most people, they're going to come into this, they're not really going after the 5-bagger. They're going after the 25 annual return. If they can just get a 25% return or a 100% return, they're happy because they're looking for annual returns.
Veteran mining investors who track this cycle tend to describe gold's rally in distinct phases or legs. Leg 1, they argue, wrapped up in January 2026, when silver approached $120 and gold neared $5,600 before both corrected hard. Leg 2, the recovery phase, is expected to pick up steam once silver reclaims the $4,400 to $4,800 range, a breakout some believe could push gold towards $6,000 to $7,000 within roughly a year. The theorized final stage, Leg 3, is where mining stocks, still seen as deeply undervalued relative to their cash flows, could finally catch up in valuation, with gold potentially testing $7,000 to $8,000.
Those people are going to be chasing this thing all the way to the top. They'll just be chase, right? And that's the majority of people. But those are the people who are going to make me a lot of money because they're going to just keep pushing these stocks higher and higher and higher. But for us speculators, you want to be really smart when you buy, really smart when you sell. And so right now, I think we're going lower. Right now, gold's about 4,100. You can buy here. There's a lot of stocks that are absolutely on sale right now. But also, you want to be ready to buy that next dip. I do think gold's going to 37.50 before November. Could be wrong. We could be breaking out here. But I'm expecting one more correction. And in Q4, I'm expecting the leg 2 to begin. So leg 1 ended in January. So leg 1 was silver got to 120, 121, and gold got to 5,600. That was the end of leg 1, the top of leg 1, and now we've corrected back. And leg 2 hasn't begun yet. And leg 2 will begin when silver gets above about 4,400, 4,500. Once it gets above those levels, it's heading to a new high. The hard part's going to be getting above those levels, especially 4,800. I think when you get to 4,800, I think it's going to fit. We're off to the races to a new high. The next leg, that second leg will start in Q4. Then we'll go all the way to around 6,500 to 7,000. And it'll take about 12 months, maybe less from now. I think less than now. So Q1 of next year, I'm expecting everything to go up 100%, which is quite a run, which is kind of what we saw last time when we went from August to January, about a 100% return or more. So I'm expecting that same thing, so that leg 2, and then it'll go higher. So 100% return like in GDX between now and Q1, and then Q2, Q3, we go all the way to 150%. And that's kind of around that 6,500 level. And that leg is actually the most important leg because that's the leg when the sentiment comes back to the miners. Like sentiment right now is really, really weak. The second leg is when these stocks start getting valued fairly. Like right now, they're undervalued. I mean, hugely, hugely undervalued in my opinion. So the second leg is when they get fairly valued. And then at the very end of the second leg, some will be highly valued. But the third leg is when we make our money. The second leg is more, okay, we're starting to run here. The third leg is when we go up to between $7,000 and $8,000 gold. So we go to let's say we go to 6,500, then we correct back to say 5,300, and then we rip to 7,500 to 8,000 in leg 3. And so we're waiting for leg 3. Leg 2, now for me, the speculator, after the big alpha, I don't really care too much about leg 2 other than the momentum's here. But leg 2 is when I basically, stop buying and sit back and wait for leg 3 to get out. And this is a trade. So at leg 3, I will sell all of my miner stocks at the top of leg 3. Now we might get a leg 4. I think we will. If we get a leg 4, I'm going to miss out on all that upside. Leg 4 means that we would go up to around 9 or 10,000. And a lot of people were expecting that. So I think leg 4 is absolutely a possibility, but I'm getting out in leg 3.